Okay, let's unpack this. Today we're doing a deep dive into a market that's well, it's throwing us some real curveballs lately. Lots of unexpected shifts, some surprising revelations. We're going to look at the EV space, some really contrasting stories there. Then there's the AI arms race, which is just, completely rewriting the rules on valuations. And finally, we'll zoom out a bit, look at those broader macroeconomic currents that, well, they shape pretty much every investment decision you make. So, our mission today, like always, is to really distill the key insights. We've got a whole stack of sources: CEO interviews, deep financial analysis, market reports, you name it. The idea is to give you a shortcut, right? To get you truly informed, find those surprising facts, those connections that really separate the signal from the noise. Hopefully, we can connect some dots for you, maybe spark a few aha moments along the way. All right, let's kick things off with the EV landscape. It really feels like a microcosm, doesn't it? You see innovation hitting market realities head on. And we've got this really stark, fascinating contrast between two big names in the EV world. One's facing some serious headwinds, the other seems to be charting a pretty strategic new path. Here's where it gets really interesting. First up, Tesla. Their Q2 earnings call is this Wednesday. And the feeling around the company, it's thick with anticipation, maybe even a little apprehension. The stock's had a rough year, hasn't it? Down about 20% year to date.
Yeah, that's significant.
It really is. It
Yeah.
puts it at the bottom of the Magnificent Seven group.
Mm.
Apple, Microsoft, Amazon, Google, Meta, Nvidia, Tesla itself. Those tech giants driving the market.
Mhm.
So Tesla's 20% slide compared to, say, Nvidia's 28% jump or even the S&P 500 7% gain, it really stands out.
Paints a picture, definitely.
It does, and analysts. The FactSet poll suggests adjusted earnings per share around 39 cents on sales of about $22.2 billion.
Which is down from last year, right?
Exactly, a noticeable drop from 52 cents per share on $25.5 billion in sales last year. So clear signs of a slowdown in profit and revenue growth. So what's behind all this? Why the struggle?
Hmm.
It's not just one thing, it seems. It's complex, multifaceted challenges.
Right, you've got a few different factors at play.
We've seen these reports of sales slumps in various places. Seems like demand might be softening generally.
Beyond just isolated issues.
And then there are these tariffs, the on-again, off-again tariffs, as they're being called,
Yeah, that creates huge uncertainty.
especially for their energy storage business, right? Because they rely heavily on batteries from China. Imagine trying to plan with trade rules constantly shifting.
It's a nightmare for supply chains and costs.
And then, well, you can't ignore the backlash against Elon Musk himself.
That's become a major factor, hasn't it?
Absolutely. His very public political activities, supporting Trump, other Republicans, talk of a third party. Sources say it has dinged Tesla's brand in the U.S. and beyond.
You hear that anecdotally, but reports suggest it's measurable now. Consumer perception shifting.
Yeah, and investors seem torn. The stock actually hit a record high back in December.
On hopes of a smoother path for autonomous tech under Trump, wasn't it?
That was the idea. But then it fell pretty fast as this anti-Musk sentiment grew politics, his moves at X, formerly Twitter.
Right.
Now it feels like investors just want to return to the basics of EVs and clean energy.
Focus on the core business. Cars, batteries, energy. Not, platform management or political statements.
Exactly. They seem to want stability, a more traditional focus. And a huge missing piece for Tesla. Still no cheaper EV.
That's a persistent issue.
Baird analyst Ben Callow directly warned about risk to full-year volume estimates without it.
It's not just about grabbing more market share either, is it? It's competitive pressure.
Oh, right. Rivals are bringing out lower-priced options. And those federal EV tax credits ending in September. That makes the need even more critical.
Could really hurt demand for the current models, the 3 and Y.
Without a more affordable entry point, they could lose ground fast. And the robotaxi rollout in Austin, okay, it's happening. It shows innovation.
But it's limited right now.
Very limited. BofA analyst Federico Merendi basically called it immaterial in the short term.
Specific areas only, still needs a safety driver.
Yeah, not the fully autonomous, scalable thing that moves the needle on revenue. Not yet. Despite all this, Tesla's guidance is still pretty optimistic. They expect the auto business to return to growth, aiming for 1.8 million EVs this year.
And energy storage.
Still projecting at least 50% year-on-year growth, which sounds great, but remember, that's down from over 110% growth last year.
So even their high growth areas are slowing down a bit relatively. What's fascinating here is seeing how tightly Tesla's performance is now linked to Musk's public image and politics.
It's unusual, isn't it?
It is. Usually we focus on the financials, the production numbers, the margins, tangible stuff.
Right.
But with Tesla, leadership focus, public perception, These intangibles are having a very tangible impact.
Amplified by social media, I suppose.
Absolutely. Every tweet, every statement gets magnified. It shows how a CEO's personal brand can become inseparable from the company's fortunes, for better or worse.
So the market's reacting to the cars and the controversy?
Exactly. Both the operational details and these less tangible things like brand image and leadership stability.
That's a really key point about the brand and leadership mix. But I wonder, is there maybe a flip side? Some might argue Musk's sheer ambition, juggling all these ventures, is what makes Tesla unique, gives it that long-term potential, even with the short-term noise.
That's the bull case, certainly. The idea of optionality across space, AI, robotics.
Right. So how do you square that with investors apparently wanting back to basics? And thinking about contrasts, does a company like Lucid with a perhaps less visible CEO gain an edge here?
It's possible a more focused narrative might resonate better with certain investors right now.
Because speaking of Lucid, they are telling a very different story.
Yeah.
Okay, let's pivot from Tesla's headwinds to, well, Lucid Motors. They seem to be making some pretty strategic moves, especially with their own robo-taxi plans. Their interim CEO, Mark Winterhoff, talked about a fantastic collaboration with Uber and Nuro.
Uber and Neuro, that's significant.
It really is. It's a big validation for Lucid's EV tech, getting buy-in from major mobility players like that.
And it opens up a whole new market for them.
Exactly. That robotaxi segment is expected to be huge. They're already testing in Vegas.
Makes sense. Neuro's got their proving ground there, real-world experience with driverless delivery.
Right, leveraging existing infrastructure. The plan is to launch in a U.S. city. Uber gets to pick which one by the end of next year, so 2026. And here's a key point Winterhoff made. This deal wasn't just a quick reaction to Tesla's Cybercab news.
Oh.
Nope. He said it's been cooking for 6 months.
Ah, so a proactive strategic move then, not just reactive.
Exactly. Shows they've been thinking about this autonomous space deliberately. And Lucid is really leaning into their tech advantage here. Winterhoff highlighted how their system uses radars to make it more bulletproof.
Unlike Tesla's camera-only approach.
Precisely. He emphasized the enhanced security, the safety aspect of having that radar redundancy. It's a direct counterpoint to Tesla's strategy.
And for anyone following the autonomy debate, that's a crucial difference. Radar has advantages in bad weather, detecting things cameras might miss.
Now, let's look at Lucid's numbers. Q2 2025, they produced 3,863 vehicles, delivered 3,309.
Which adds up to?
Over 6,000 for the first half of the year. And he said this was their 6th consecutive record delivery number for a quarter.
So, consistent improvement there, building momentum.
Looks like it. And they expect drastically higher production and deliveries in the second half, especially once the Gravity SUV gets going.
Have they sorted out those supplier issues they had?
Winterhoff mentioned getting past speed bumps with suppliers and shortage topics suggests they're smoothing out the production scaling, which is definitely a positive sign for investors. Another interesting move, that proposed reverse stock split, 1 for 10.
Why are they doing that?
Winterhoff called it a technical exercise, basically to open the investor base to big institutional players.
Ah, because many funds have minimum price rules for investing.
Exactly. A higher share price gets them onto more institutional radars. He also sort of implied it might help reduce the amount of retail investors focused on short-term flips, aiming for more long-term investors.
Trying to stabilize the shareholder base. Makes sense for a company needing long-term capital.
And looking at the competition, Winterhoff acknowledged China's strength in robo-taxis, BYD, Baidu.
They're moving fast over there.
He said he was impressed with the quality he saw at the Shanghai Auto Show, but he still thinks Lucid has an edge when it comes to the right comfort and the driving dynamics.
Playing to their luxury strengths.
Yeah, claiming they're still on a different planet there. But he stressed the U.S. needs to keep innovating to stay ahead globally. And get this, about 50% of new Lucid buyers, they used to own Teslas.
50%. Wow, that's a significant number.
Right. And Winterhoff said it hasn't really changed dramatically since March. Consistent trend.
So why are they switching? Is it just the Musk factor?
He suggested it's less about Musk's politics and more that customers feel that Tesla hasn't really changed in the last 10 years.
Looking for something newer, maybe better tech.
Exactly. Looking for something newer and something that even has better technology when it comes to the EV technology. It points to a desire for fresh innovation, advanced performance, maybe that premium feel, not just brand loyalty or political reaction.
So if you connect this back to the bigger picture, Lucid's strategy seems very focused, doesn't it?
Yeah, it feels deliberate.
That emphasis on radar-backed autonomy, the careful move to attract institutional money. It's quite different from Tesla's approach, which feels broader, maybe more diversified, but also potentially more distracted, like you said.
Right, Tesla's into robots, social media.
While Lucid seems laser-focused on the core EV tech and strategic partnerships in areas like robotaxis, it really makes you wonder, especially in such a capital-heavy industry, if that focused approach, even for a smaller player, might lead to more consistent growth and validation over time.
Especially with competition heating up everywhere.
Exactly. Maybe focus beats breadth in this phase of the EV race.
What a contrast, huh? These EV battles are intense. But if that's the ground war, the AI sector feels more like, I don't know, an aerial bombardment reshaping the entire landscape.
Yeah, the valuations are certainly explosive.
Right. Let's pivot there. The high-stakes AI arms race. Incredible growth, intense competition, and some frankly eye-watering valuations that make you look twice. Let's start with Palantir Technologies. What an explosive AI growth story that's been.
Unbelievable, Rob.
The stock surged, over 1,600% since 2023, hit a high of $155 this year.
Wow.
And it's fueled by demand for their AI software foundry for businesses, Gotham for government. Both commercial and government sectors are buying in big time.
They seem to be hitting their stride on both trains.
The numbers show it. Q1 2025 revenue was $883.86 million. That's up 39% from Q1 last year.
And the U.S. commercial side.
That jumped 71% to $255 million. Huge growth there. Annual revenue hit $2.86 billion. And they're profitable now, too, right?
Yes, that's a key shift.
Q1 net income, $214 million. It's a 24% profit margin. Adjusted operating income was $391 million.
Strong cash flow, too.
Yeah, cash from operations, $310 million. Free cash flow, $370 million. Really solid financial health indicators.
And new business.
Booming. Total contract value, PCV, hit a record $810 million, up 183% year over year.
Wow, 183%.
And remaining deal value, RDV, the future revenue locked in, reached $2.32 billion, up 127%. Shows a massive pipeline. Looking ahead, Q2 revenue forecast is between $934 and $938 million. Continued growth.
And for the full year.
They're guiding for $3.89 to $3.9 billion. And they expect U.S. commercial revenue to grow at least 68% this year, hitting over $1.17 billion.
Really doubling down on that commercial expansion.
Seems like it. And they reaffirmed GAAP profitability every quarter going forward. Confidence is high. Okay, now the valuation, the elephant in the room, is their price to sales ratio, 121.28.
Oof, that's extraordinarily high.
Right. Typical software companies might be 10, 20 times sales. Palantir's over 120.
Meaning investors are paying $121 for every $1 of revenue.
Exactly. And the PE ratio, almost 660.
So the market has priced in years, maybe decades, of future growth already.
Makes the stock incredibly vulnerable, doesn't it? Any stumble, any miss.
And the correction could be sharp.
And when you compare it to other big tech names...
Like ASML.
Yeah, ASML. $292 billion market cap, near monopoly on those essential EUV machines for chip making, trades at a much lower valuation.
Looking at an IBM or Salesforce.
Right. IBM at $266 billion. Salesforce, the CRM leader integrating AI, trading near the S&P average PE. They look almost cheap compared to Palantir.
So what's the argument for Palantir's premium?
It's that unique position, right? That deep integration across government and commercial.
Yeah.
They're seen as operating at the core of AI, providing the underlying infrastructure, not just adding AI features.
So the market's betting they become the essential platform for AI deployment at scale.
That seems to be the bet reflected in that premium price. Quick look at the technicals. Stock's been in an ascending, broadening wedge. Think wider price swings as it moves up volatility, but upward momentum.
Breakout above $125 in May boosted that.
Yep. And before that, there was that big inverted head and shoulders pattern from 2021-2024. The breakout above $40 really kicked off this huge run.
And short term.
Seeing a cut pattern with a neckline around $125. Now trading in an ascending channel, bumping up against resistance near $155.
So technically, a pullback to $140 or $125 could be a buy zone for bulls.
That's what some analysts are suggesting, if you believe a long-term story despite the valuation.
This really raises that critical question for you, the investor. How do you balance that undeniable explosive growth against valuation metrics that are just stretched incredibly thin?
It's tough.
It is. Palantir is almost a case study in growth at any price thinking, driven by this intense AI enthusiasm.
Mhm.
Investors are paying up massively for Proceed's future dominance.
Betting on the transformation.
Exactly. But the risk is huge. Can they actually deliver the growth that's already baked into that stock price? Any deviation, any change in sentiment, and it could get painful. It really tests your definition of value in this tech environment.
A real dilemma. Okay, now let's shift to another AI giant, but one playing more defense, it seems. Alphabet, Google's parent.
Facing some serious challenges now.
Yeah, unprecedented threats from AI rivals like OpenAI, Perplexity.
They've pulled in tens of millions of users already, haven't they?
They have, and now they're coming after Chrome's dominance with their own AI browsers.
Just as Google's facing that potential forced Chrome sale in the courts.
Talk about a pincer movement. It could really disrupt Google's ecosystem. So Alphabet's counter strategy, they're rolling out AI overviews and search those AI summaries at the top.
How's the uptake on those?
Huge. 1.5 billion users per month already. Massive adoption.
Wow.
They're also pushing their Gemini AI models more to enterprise users, trying to compete there.
And they landed OpenAI as a cloud customer.
Yeah.
That was interesting.
Yeah, a bit of a frenemy move, wasn't it? Leveraging their cloud strength even against a direct search competitor. Turns a rival into a revenue source. Smart, in a way. And integrating AI into search is vital for their ads, isn't it?
Absolutely key. Better targeting, potentially better returns for advertisers.
Both analysts think those AI targeting advantages and increasing ad loads in AI overviews could drive ad performance above traditional search.
Which they desperately need to protect that core revenue.
But there's the threat, right? D.A. Davidson's Gil Luria pointed out the bigger threat is when OpenAI and Perplexity get big enough to sell ads themselves.
That's when Google could really feel the pain, lose advertisers, lose revenue.
Exactly. It's all about keeping those advertisers locked in. And let's not forget Waymo, Alphabet's self-driving unit.
Often overlooked in earnings calls.
But maybe not for long. With Tesla making noise about robotaxis, Waymo's been quietly operating, racking up miles for years.
A very different, more cautious approach than Tesla's.
Could become a bigger part of the story now. As for Q2 expectations for Alphabet overall, LSEG data suggests about an 11% jump in total revenue.
Ad revenue up too.
Yeah, about 7.5%. And cloud computing still strong, expected up 26%. Earnings per share around $2.18.
Pretty solid numbers expected, but the stock's been flat this year.
Largely flat, yeah. Lagging most of the Mag 7. Still, analysts are generally positive. Average rating is buy. Median price target around $204.
It's fascinating, isn't it, watching a giant like Alphabet adapt. They're not just sitting back.
No, they're actively fighting back.
They're leveraging everything they have, scale, user base, even their rivals' need for cloud infrastructure to protect that core search and ad business. They're trying to integrate the disruptive AI tech itself.
Using the threat as part of the defense.
Exactly. It's a classic incumbent strategy. Innovate from within, use your resources to stay ahead. The big question is, can that sheer scale hold off these nimble AI-first challengers in the long run?
Time will tell on that one. Okay, so we've seen these intense battles in EVs and AI.
Oh.
Now let's pull back the lens. Let's look at the bigger picture, those macro forces.
That's stuff that affects everyone.
Right. Tariffs, central bank policies. These things shape the entire investment landscape. So what does it all mean for you, the investor trying to navigate this? First up, trade tensions and tariffs. Still a major source of anxiety, aren't they?
A key source of unease, definitely.
Yeah.
And that August 1st deadline is looming.
For new tariff decisions, right? And reports say European policymakers are prepping contingency plans targeting up to $72 billion in goods if talks break down.
That's serious money, not just posturing.
No, it would hit actual corporate earnings, disrupt supply chains. Look at GM. Their Q2 profit dropped 32% to $3 billion.
And they specifically blamed tariffs.
Yep. Said challenging tariff policies cost them $1.1 billion in the quarter.
Oh.
$1 billion just from trade friction.
Wow. That's a direct hit to the bottom line.
And this ties right back to EVs, doesn't it?
Absolutely.
We talked about Tesla and its challenges with those on-again, off-again tariffs on batteries from China.
Makes planning almost impossible, adds costs, uncertainty.
It just shows how these big macro policies create this pervasive uncertainty that hits specific companies and sectors hard, affects costs, supply chains, investment decisions everywhere.
If you connect that to the bigger picture, These kinds of protectionist policies, they don't just affect the specific goods targeted.
No, the ripples spread out.
Exactly.
Yeah.
They mess up global supply chains, force companies to rethink where they build things, potentially raise costs for everyone.
Deters investment too, probably.
Definitely deters cross-border investment, slows down overall growth, and can even spark retaliation, leading to escalating disputes. It undermines stability. What starts as one tariff can snowball into a major global economic drag.
Okay, so trade uncertainty is one piece. Let's talk about the Fed. Everyone's watching them ahead of the July 30th meeting.
What's the market pricing in?
CME FedWatch shows a 97% probability they hold rates steady, so almost certain no change this time.
Because inflation's still sticky.
Yeah, persistence near the 3% mark, still above target, and the economic data is just mixed. Some cooling, some strength. So the Fed's staying cautious, data dependent.
No clear path forward yet.
And in that kind of environment, look what's happening to yields. Real yields on 10-year treasuries are down over 6 basis points.
Making non-yielding assets relatively more attractive.
Exactly. Lowers the opportunity cost of holding something like gold. And the U.S. dollar index, the DXY, down 0.64%.
Reflecting lower rate hike odds and maybe some uncertainty about central bank independence.
Seems likely. And a weaker dollar usually helps gold and silver globally, makes them cheaper in other currencies. Plus, you see the People's Bank of China holding rates steady too. It's a broader theme of policy conservatism right now. So you put all that together, the economic ambiguity, the sticky inflation, the cautious central banks, the trade tensions.
And you get classic conditions for safe haven demand.
Right. Precious metals like gold and silver become more appealing. The short-term forecast, they might stay range-bound for a bit.
Supported by those weaker real yields and the general caution.
Yeah, expected Fed pause, ongoing trade risks, it all keeps investors interested in these traditional safety plays. Quick look at the charts here. Gold broke out of a symmetrical triangle pattern.
Bullish signal, usually.
Often is. It rallied past 3,377 resistance, touched $3,402 briefly, now around $3,385. If it holds above $3,402, the next targets could be $3,426, maybe $3,451.
And if it drops below $3,377.
Then you might see pullbacks to 3,345 cents or 3,331 cents. For silver, it's consolidating just under 2 resistance, around $39.12.
Support holding.
Around below $38.41 could see it test those moving averages around $38 or even lower.
Could pull back towards $38.04 or $37.61.
What's really fascinating here, I think, is seeing that direct link. The Fed's caution, driven by inflation and mixed data, plus those geopolitical tensions from trade, it translates directly into investor behavior.
Moving capital around. Exactly. Allocating towards perceived safety. In times of ambiguity and risk like this, even subtle shifts in policy outlook or trade news can significantly boost the appeal of gold and silver.
Shows their role in a portfolio.
Absolutely. Their enduring role as a hedge against volatility and uncertainty is really highlighted in moments like these.
Wow, okay. We covered a lot of ground today. We looked at those really different paths in the EV market. Tesla grappling with challenges, Lucid making strategic plays, leadership, technology, it's all in the mix. Then we dove into that AI race, Palantir's explosive growth and sky-high valuation versus Alphabet's defensive maneuvers against new threats.
Really reshaping market expectations.
Totally. And finally, we tied it all back to those fundamental macro forces, the impact of tariffs, the cautious dance of central banks showing how they underpin everything, driving flows into safe havens, hopefully understanding how these different pieces connect the company's stories, the tech trends, the macro backdrop helps you cut through the noise.
Make more informed decisions.
Yeah, spot those connections, those aha moments that clarify what's really driving the market.
And maybe this leaves you with a question to think about. We see technology innovating at lightning speed, right? AI, EVs, everything moving so fast. But we also have these persistent economic headwinds, these geopolitical risks.
Yeah, a real tension there.
So the question is, how long can that incredible innovation outrun the challenging economic reality? And looking out over the next decade, which forced the tech disruption from EVs or AI or maybe a bigger macro shift, will ultimately be the most powerful shaper of the investment landscape. Something to ponder.
That is indeed the big question, isn't it? Food for thought. Well, thank you for joining us on this deep dive today. We hope pulling these threads together helps you stay informed and navigate these really dynamic markets. We'll be back soon with our next analysis. Keep exploring.